This is an Uncovered Japan Company Research Report on GEO Holdings, ticker 2681. GEO is Japan's largest reuse retailer, spanning Second Street, secondhand stores, games, smartphones, luxury goods, and digital content. The investment story combines a broad reuse platform, a growing overseas store network, and a valuation that still sits below book value. At the report date, GEO traded at a trailing price-to-earnings ratio of 9.6 times and 0.85 times book value. Fiscal 2026 revenue reached 481.2 billion yen, and return on equity recovered to 8.9%. Those figures make the key question straightforward. Can expansion and mix improvement earn a more durable valuation without stretching the balance sheet too far? GEO's product is a reuse ecosystem rather than a single store format. Customers can sell and buy pre-owned apparel, accessories, games, smartphones, furniture, appliances, and luxury goods. Second Street is the flagship apparel chain, while the group also operates digital content through Vivian. The common capability is an in-house buyback and pricing system that helps match local supply with resale demand. The financial record shows meaningful growth, although not in a straight line. Revenue rose from 334.8 billion yen in fiscal 2022 to 481.2 billion yen in fiscal 2026, a 5-year compound annual growth rate of 9.5%. Operating profit grew faster over the same span, at 14.9% annually, but fiscal 2025 showed that execution and mix can still create volatility. The sales mix explains both GEO's opportunity and its margin debate. Reuse categories accounted for 62.5% of fiscal 2026 sales, led by apparel and accessories through Second Street. Higher growth digital content is smaller, while low-margin new goods and the legacy rental business dilute the headline margin. The future case depends on whether the higher-value reuse and digital mix keeps taking share. Store expansion has required substantial investment, so cash flow is an important reality check. Operating cash flow improved to 19.5 billion yen in fiscal 2026, and free cash flow turned positive at 4.2 billion yen after several negative years. That is encouraging, but it does not remove the need to track investment discipline as the network continues to grow. The balance sheet is built for expansion, not for a mature income profile. GEO's equity ratio fell to 33.2% as it invested in stores, while return on equity recovered to 8.9% in fiscal 2026. The report characterizes the balance sheet as stretched, but not stressed. Investors should watch whether future store rollouts can be funded while preserving that resilience. GEO's moat is primarily operational. Its broad category coverage and large store network bring in both sellers and buyers. The in-house buyback and pricing system gives the group a practical advantage in converting local inventory into sales. The hybrid new goods and reuse model can sacrifice headline margin, but it also supports customer traffic and makes the platform harder to replicate, category by category. Management's long-term ambition is to grow group revenue toward 1 trillion yen by fiscal 2036. The report identifies overseas Second Street expansion and a richer reuse mix as the two main engines. It also notes that management has a record of meeting commitments early. Still, the scale of the target makes execution, financing, and transparent digital commerce disclosure the variables that matter most. On the report's trailing figures, GEO's 9.6 times earnings multiple was below its approximate 5-year average of 11.5 times, while the shares traded below book value. The report attributes that discount to the low operating margin and falling equity ratio during the growth phase. The valuation is therefore a starting point for research, not a conclusion by itself. The report's author-built scenarios frame the asymmetry rather than a price target. From the 2,106 yen reference price, the 3-year bear case is roughly 19% lower, the base case roughly 33% higher, and the bull case roughly 99% higher. Those ranges depend on store expansion, margin mix, and the market's willingness to value the business differently. So they should be treated as scenarios, not forecasts. To sum up, GEO offers a scaled position in Japan's growing reuse market, supported by a wide store network, an operational buyback system, and overseas expansion potential. The counterweights are visible: low headline margins, continued investment needs, financing discipline, and near-term supply demand in the shares. The full Uncovered Japan deep dives set out the evidence and the risks in more detail. For a much deeper look, Visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.